Markus is going to be presenting the next paper, and the title is Deep Learning in Asset Pricing. And Markus, take it away. You have 25 minutes.
Alberto, thank you so much for including me here in the program. This is joint work with my PhD students Luyan, Chen and Jason Su, both from Stanford University. So in this paper, we want to tackle one of the most important questions in asset pricing, namely understanding why do we observe different expected returns for different assets. We know the answer to this question is the exposure to systematic risk as measured by a stochastic discount factor. So we should observe different expected returns because assets have a different exposure to this SDF. Now the big question is now to estimate this SDF. So the title of today's session is Asset Management, and I just want to highlight that asset pricing and investment are just two sides of the same coin, because this SDF portfolio will actually be a mean variance efficient portfolio, so it will be an attractive investment opportunity. And if I have an asset pricing model, I can identify under or overpriced assets, and obviously this also maps into investment strategies. Okay, so the question is to estimate the SDF, but that is a challenging problem for a number of reasons. So first, the SDF should depend on all available economic information, and that means there are a lot of variables and have a big data problem. Number two, there's no reason that the functional form of this relationship should be simple, like linear, so it can be complex, as Turan has pointed out in his work, and Brian as well. Number three, dynamics should matter. For example, the exposure to risk and the price of risk during a boom can be different than during a time of a recession, and somehow we need to incorporate these dynamics. Now, can machine learning methods help? And when I talk about machine learning methods, I refer to methods that are flexible in terms of their functional form, so they're non-parametric, and they can deal with many variables because they have some form of regularization. Now, the issue is that if you look at stock returns, we have a relatively low signal-to-noise ratio. As Brian has shown in his work, depending on the data and the methods that you use, less than 1% of stock returns is predictable. But this predictable part is exactly where the risk premium is, and that's what we care about for asset pricing. And now what we do in this paper, we include economic structure, more specifically, a no arbitrage condition, and we show that this helps to push up the signal in the data and to detect a more meaningful economic model. Now, before I go into the model, I want to highlight three key challenges that we have to deal with in asset pricing and how we solve those. Number one is, what is the SDF and how does it depend on my information set? So very popular models are linear factor models. Very well known is the Farmer-French 5-factor model. This assumes that the SDF is a linear function of 5 factors. And for the Farmer-French 5-factor model, the SDF depends only on size, book to market, investment, and profitability characteristic information. Now, the linear form is likely misspecified, and there are hundreds of potential characteristics to predict returns. So what we are doing in this paper, we have a very general framework that allows us to estimate what is the functional form. It doesn't need to be linear. And we can also make statements about what are the relevant variables to span the SDF. Number two is a very important problem. Unfortunately, it has not received the attention it should in the literature, and that's about test assets. So I need test assets to evaluate which asset pricing model is good or bad, and I also need to calibrate an asset pricing model. Very popular test assets are the 25 Farmer-French portfolios, double sorted on size and book-to-market ratio. The issue is if I have an asset pricing model that can price those 25 test assets, it doesn't mean that it's going to work on other test assets. So what we argue in this paper is that if you want to calibrate an asset pricing model, you should use all stocks and any possible characteristics or portfolios that you can get with these stocks. And we do this in a data-driven way. Number three is about dynamics. So booms or recessions should have an effect on asset pricing, for example. Now, one way to incorporate that is to use NBR recession indicators, potentially interacted with other variables. Now, the issue is that we have hundreds of macroeconomic time series with very complex dynamics. And so there should be more information that we can use. And so what we are going to do here is to extract from a large dimensional panel of macroeconomic time series a small number of economic states that are relevant for asset pricing. All right, so this paper is about estimating the SDF with deep neural networks. And the key innovation is to use a no arbitrage objective function to do this estimation. Actually, we are not going to have one neural network, but our model has 3 different neural networks, and each is going to tackle one of the challenges that I've outlined before. There will be one neural network that estimates the SDF as a function of my information set. There will be a second neural network that extracts the economic states that I can condition my SDF on. And there will be a third neural network that generates the informative test assets that I need to calibrate my asset pricing model on. And these 3 neural networks are glued together by a no arbitrage condition. I just want to highlight, this is a very general model, which includes essentially all other models as a special case. So what are the findings? So first, empirically, our framework seems to work really well. And I will only talk about out-of-sample results here. And when I mean it works well, I mean what is the Sharpe ratio that our SDF can achieve out of sample, which is 2.6 for 25 years out of sample, which is much higher than the other benchmark models we consider. We can explain 8% of the variation in individual stock returns. And if we look at conventional test assets, and these are portfolio sorts, we get cross-sectional R-squares higher than 90% for all possible test assets that we look at. So it seems to work really, really well, but we can also learn something about the structure of the SDF. So first, it seems that nonlinearities do not matter that much if you look at asset pricing, if you look at characteristics in isolation. So there seems to be a reason why linear factor models are so successful. However, if you look at the interaction between characteristics, that's where the nonlinearities come in. To put it simple, small stocks are different from small value stocks, and the interaction between size and value is a nonlinear interaction. It matters to include macroeconomic conditions, and once you do it, you get a very stable asset pricing model. You can also make statements about what are the variables that matter the most for asset pricing. Now, if there's one takeaway of my talk today, is that economic conditions matter if you want to use machine learning methods. For the task of asset pricing, it seems that if you use a linear model that includes economic structure in the form of a no arbitrage objective function, it can do better if you use off-the-shelf prediction method. However, if you combine the flexibility of machine learning with economic insights, you can get a very powerful model framework that can capture a lot of economic structure. I just want to briefly highlight the literature here. So there's one part of the literature that relates to what Turan just presented. I think the most important paper there is a pioneering work by Brian. And this literature has shown that machine learning methods are very helpful for finance, and nonlinearities and regularization is important when it comes to predicting returns. Now, this literature is taking more or less off-the-shelf methods and is not including an economic structure per se. There's another part of the literature, and this literature typically looks at more constrained functional forms, typically linear models, but uses a large number of linear factors, for example, but then uses economic structure to find an SDF. And this literature has shown that including this kind of economic structure will help to get better asset pricing models. Now, what I'm going to do today is I will combine the flexibility of machine learning with an economic structure. And I will show that this will bring us a lot of benefits in estimating an SDF model. And here I build on insights that Brian has already shown in one of his papers, where he also combined machine learning models with some economic structure to get better factor models. All right, let me start now with the model framework. So I care about excess returns. That means returns minus the risk-free rate of different stocks. And if I multiply those with an SDF, which I denote by M, the conditional expected value should be 0. That's the fundamental no arbitrage condition. Now note that if I take a variable that I can observe at time t, that means a measurable random variable at time t, I can create unconditional moment equations. Now, no arbitrage essentially just implies an infinite number of unconditional moment equations. Now, what I want to estimate is an SDF. And without a lot of generality, I can project my SDF on the return space. So what I want to estimate is a portfolio of all stock returns with time-varying portfolio weights, where these portfolio weights can be functions of my information set. Now we'll split my information set into macroeconomic information, that could be inflation rates, GDP growth, etc., and firm-specific characteristic, size, value, momentum, past returns. And so my SDF weights are general nonlinear functions of a large number of variables. Now, from standard textbook arguments, we know that this conditional no arbitrage equation is equivalent to one factor model, where I have my SDF, I have an SDF beta, which is time varying because it's a function of my general information set. And so what I want to do is I want to estimate my SDF weights. That gives me an SDF. Then I can get SDF betas. And once I have those, I can do asset pricing. For example, at each point in time, I can run a cross-sectional regression on my time varying betas to get a residual, and then I can analyze my asset pricing results. So how are we going to do the estimation? So let's say I fix a conditioning function G. So a conditioning function G is just applied to my information set that I use to generate these unconditional moments. So let's say I fix that. Then I can look at sample moments and I do a classical general method of moment estimation to get my SDF. Now the twist here is that I use feed-forward neural networks to estimate my SDF to explain all these sample moments for a given conditioning variable. Now the next step is important, so please pay attention. If I take excess returns and I multiply them with a conditioning variable, I essentially form characteristic managed portfolios. One example would be a G that is an indicator function that is 1 if I have small cap stocks and 0 otherwise. In that case, I form characteristic managed portfolios that are small cap stocks. So choosing conditioning function is the same as forming test assets or choosing instruments for a GMM problem, right? So by choosing my conditioning function, I choose which test assets I want to price with my asset pricing model. Now, the issue here is that I have an infinite number of candidate choices for my instruments or test assets, and I need to find a criterion to select those. We are going to do this with a generative adversarial network approach. So let's say I've chosen my test assets G, then I will try to find an SDF that minimizes the pricing errors for these test assets. Now I will actually have two networks. I will introduce an adversarial or conditional network that plays a zero-sum game with my SDF network. Given an estimated SDF, I'm trying to generate test assets that my asset pricing model cannot explain yet. And now I will have an iterative game. So given these new test assets, I want to improve my SDF to explain those as well. Now, what I'm describing here is just a process that we do in the finance profession for the last 40 years, but I do it in a machine learning way. For example, let's say my SDF is a Pharma French 5 factor model. We know that Pharma has essentially given up on pricing momentum portfolios. So what my SDF might do here, or what my adversarial network might do, it might propose momentum sorted portfolios. And then I might add a momentum factor to my SDF to explain those as well. Now, finding optimal instruments is something that econometricians have obviously done in the past. So in the conventional GMM framework, these arguments are based on efficiency. Now, that is not going to work here. And the reason is because I have an infinite number of parameters without necessarily a normal distribution from my estimator and an infinite number of candidate instruments. So the standard arguments break down here. There's another issue that's related to identification, and I'm happy to talk more about this why arguments like in Nagel and Singleton are not going to work here. But what we do is we use a robustness argument. We want to control the worst possible pricing error in this economy. And I argue that's the right argument if we care about identification of SDF parameters. Are we done yet? Well, we still need to deal with the dynamics. And the question here is how can we incorporate macroeconomic time series in our SDF model? Now note that most macroeconomic time series are non-stationary, as you know. For example, here this is S&P 500 price. So what do? We take some form of increments. Here I take obviously log increments to get S&P 500 returns. Now if I just take the last period log return as an increment to my asset pricing model, I neglect all the dynamics. I cannot infer from last period's log return if I'm in a boom or recession. I need to include all past log returns to do that. So more specifically, once we have made our macroeconomic time series stationary, we would need to take into account all the lagged increments in our model. Now, if I have hundreds of macroeconomic variables and I include all their lagged values, these are too many variables. These models are going to break down, even with regularization. And we would also ignore the time structure that's inherent in these variables. So what we propose is an LSTM framework. So an LSTM is a long short-term memory cell network. And all of you have used them before, even if you're not aware of this. So LSTMs are used by Apple Siri, Android speech recognitions, and Amazon's Alexa. So LSTMs are great when it comes to text or speech data, which is also a time series, but we show how to use them for financial time series here. And what they're going to do is twofold. So number one, they take this large dimensional panel of macroeconomic increments, and they will reduce them cross-sectionally to a small number of macroeconomic factors, then extract a dynamic state out of this time series. So it's like a combination of a nonlinear PCA with a nonlinear Kalman filter on an intuitive level. So what we are going to get out here is a small number of economic states like boom or recession. So how is it going to work? Well, this is a diagram. So given the macroeconomic time series, we extract a small number of economic states. We combine those with firm-specific characteristics to get an SDF, asset pricing model. We estimate the SDF to price test assets. We have an adversarial or conditional network that creates its own economic states and uses firm-specific characteristics to generate test assets that we can't explain well. But now our model will learn to explain those as well, iteratively, and that will be our GAN estimator. Let me come to the empirics. So we have a very standard data set here, which are basically all stock returns from CRISP with 46 firm-specific characteristics, 178 macroeconomic variables. We use the first 20 years for estimating our asset pricing models, 5 years to select some tuning parameters. The next 25 years are pure out of sample. So we're not re-estimating our model. The only reason why we capture time variation is because our input variables like characteristics or macroeconomic time series are time varying. But the function, the asset pricing function is constant that we estimate. So we compare our model with two special cases. So one special case is if you take our model framework, but you restrict all functional forms to be linear. So our characteristics are normalized to be normalized ranks where 0 is the median value. If you normalize everything, so if you look at the linear version of our model, you essentially end up by creating long-short factors, rank-sorted long-short factors, and then you apply mean variance optimization to those. So the special case of what we're doing is mean variance optimization with long-short factors. Because we have a very large number of factors to make the comparison fair, we also include a regularization, more specifically an elastic net penalty. So the linear special case of our model is mean variance optimization on standard long-short factors with some regularization involved. The other extreme is to take the full flexibility of machine learning, but not include an economic structure. So here we're going to use the best performing model of Brian's machine learning forecasting paper. And what I just want to highlight is when you do forecasting, you also estimate an asset pricing model. Because if a no arbitrage model holds, the conditional mean, that means the forecasted return, should be proportional to an SDF beta. And once I have an SDF beta, I can infer my asset pricing metrics, right? So this will be another special case. And so for these models, we are going to estimate SDFs. We estimate the SDF betas. Then we can run at each point in time this cross-sectional regression to get a residual. And then we do asset pricing. So we're going to report the Sharpe ratios of the SDFs, the explained variations, which is essentially the squared residuals averaged over time and cross-section. Or we first take the time series mean of these residuals, which gives us an alpha, and then we square those alphas and average them over the cross-section. These are standard asset pricing metrics, just generalized to this non-parametric framework. So here are the main results. So please focus only on the out-of-sample test results. Our model is GAN, this generative adversarial network, and we get an out-of-sample Sharpe ratio monthly of 0.75, which is higher than the Sharpe ratio that we get for a forecasting model, which we denote by FFN, or the two linear models, where the EN, elastic net model, is a linear model with regularization. We explain out of sample twice as much variation for individual stocks, and we have around 30% higher cross-sectional R-squared for individual stocks. Now, one thing that I found interesting is that the linear factor model with regularization seems to get better numbers for this asset pricing exercise than if you do simple forecasting. And that's why I think it matters to include economic structure in this high noise ratio environment. Now, what matters for our model, right? We have a lot of features that come into our framework, so we want to figure out what is the importance of the different elements. Here, I'm showing you the out-of-sample Sharpe ratio by using different features of our model. So one thing we can do is to take just last period's macroeconomic increments. And I just want to highlight a lot of papers just do that. If you do that out of sample, all our models will deteriorate because last period's increment are typically not that informative for an asset pricing context. And so you have just a lot of uninformative variables. So in spite of regularization, out of sample, the results will deteriorate. If you leave the macroeconomic information out, so you estimate the models only using firm-specific characteristics, you get these orange bars. In our benchmark model, the one that I've shown you on the last slide, is this top bar. And that's around 10% larger than if you use our GAN without macroeconomic states. So you can say there is a 10% gain from including macroeconomic conditions. Another extreme case is if I take all macroeconomic states, so I have the LSTM, but I don't do the GAN part. So I take unconditional stock returns for pricing. Mathematically, my G function is an identity. So I just want to explain unconditionally the stock return, all the stock returns in my sample without forming these portfolios. Then I have around a 20% loss in out-of-sample Sharpe ratio. So we argue that finding informative test assets is the more important part, but both elements, economic states and informative test assets, matter to get a good out-of-sample asset pricing model. Now we can use our model for prediction. This comes back to the topic of the day, which is investment management, because we get SDF betas and we can sort all our stocks based on SDF betas. So we can get 10 decile portfolios. And if you look at the returns of these SDF beta sorted portfolios in the next period, and here I show you the cumulative returns out of sample, that's after 89. You see high beta has higher future returns, low beta has lower future returns. And we actually have a perfect monotonic relationship. So we can do prediction as well, but the focus of our model is to explain expected returns, asset pricing. So what I can do is I have 46 characteristics. For each of these characteristics, I can form 10 value-weighted decile portfolios, which gives me 460 standard test assets. And I can look at the mean returns of these portfolios and the model implied mean return. And I do this here for the GAN model. If all these points would be on a 45-degree line, I would have a perfect model. I don't have a perfect model, but I get the monotonicity right. If I use a forecasting model, you see there are more characteristics for the portfolios that are mispriced, and the same holds if you use these linear models. So in this sense, we have better asset pricing results. And we show this with metrics for all of these individual test assets. All right, now we have a good SDF, but what is it? Now our SDF is a time series, so I can look at correlation measures or factor spanning tests to understand it better. One test could be to run a time series regression of Fama-French 5 factors. Bottom line is only the intercept is highly significant and Fama-French 5 is not going to span our SDF. Neither will other simple linear factor models. So what does our SDF depend on? Well, we have a lot of characteristic information here, and so it's a little bit harder to talk about importance. So what we are going to use is an absolute gradient importance measure. So if you run a regression, you can look at the slope coefficients of your regression to say which variable is more or less important. Now, what we are doing is the gradient, which is a derivative with respect to one variable, and we average it over the whole data, which is a generalization of the slope ID. And really the main point for our importance measure that we have here is that we put all our characteristics into 6 categories: trading frictions, value, intangible, profitability, investment, past returns. And among the most important variables, all these standard categories are represented. And that doesn't need to be the case. If you do simple forecasting, the top 14 variables seem to be mainly in the trading friction and past return category. And those are the categories where you have a lot of small, illiquid penny stocks. So there might be a risk that if you do standard prediction, you're overfitting illiquid penny stocks. And it seems that our model, because of the adversarial feature, does it not. We also talk about interpreting the macroeconomic states. In our model, there should be 4 economic states. Just to give you some high-level intuition, I'm showing here the time series of our economic states. The gray shaded areas are NBR recessions. And if you look at the third macro state variable that we have, it will always spike downwards right after a recession, while the fourth one will spike upwards right after a recession. So they seem to be related to general economic activity. So last but not least, that's the last part I want to talk about. What is the functional relationship of our model? Now, our SDF weights are a function of a lot of parameters, so I cannot give you a plot of this very high dimensional object, but what I can do is I can fix all parameters, all variables at their median value except for one. That gives me a one-dimensional function. So I can show you the effect of size or value on the SDF. It turns out that for all characteristics, we have functional relationships that are close to linear. However, if I look at the same function for size, but among value stocks or growth stocks, so I fix another variable at a different quantile, you see that there are nonlinear effects. The same if I look at the value effect among large cap stocks and small cap stocks. So there are interaction effects that come in. I could just give you the 2-dimensional functional plot for size and value. The general monotonicities are as you would expect them, but there are nonlinear interaction effects. And that's what we document, and that is what we believe makes our model better than, for example, linear factor models. I just want to highlight, we have tons of robustness tests. So we have results that show that our results are not driven by small cap stocks. So our results are qualitatively robust to market capitalization. We discuss a lot the choice of tuning parameters, and our results are robust to the choice of the tuning parameters. So it doesn't matter if we take the best, second, third, or fourth best model from the validation data. They're essentially all identical. And we also look at time stability. So we do a rolling window fit. We play around with the time periods. The results are essentially the same. So we believe what we fit is a robust economic structure. I think I'm running out of time, so let me wrap up here. So this paper is about estimating asset pricing models with deep neural networks. We introduce some new features here. One is this adversarial ID to get informative test assets. The other one is to get economic states with an LSTM. And we bring all of this together in this GMM type framework. And we show that out of sample, we get very strong results, and we can make statements about the structure of the SDF. The paper has more results, also the link to conditional factor models, to the very nice work that Brian has done in that space and how that's related to our adversarial estimation approach. And we also talk about the implication to investment management. I'm going to stop here now, and I look forward to your questions. Unfortunately, my co-authors are not in the audience, so I couldn't reply to your chat questions.
No problem. I'll just propose them to you right now, Marcus, don't worry. So yeah, Gustavo Schwenker was asking, is the Sharpe ratio measure including or excluding fees?
Well, we do it here like most other papers have done it, which means once you take trading frictions, for example, fees into account, the Sharpe ratios would be lower. So think about it as a theoretical number that you could achieve as an upper bound in some way. But obviously, if you want to trade it, their fees will lower the results.
Yeah, and I think I also have, I mean, Neil Stodden was also kind of commenting on this. Was he saying like, doesn't this kind of the results that you're showing towards the end of the presentation, don't those results imply that the cost of trading small and liquid stocks need to be considered when you're in the implementation?
I love this question. It is a wonderful question. It's actually related to a really great comment Brian made at a conference about what are we trying to fit? Are we trying to explain small cap stocks with our model? And on a high level. So first of all, you can put some constraints on what the test asset should be. So you could in some way exclude test assets that might be more prone to trading frictions. And we show in the paper that this is not driving our results. But there's a bigger picture question here, and that is more from the investment perspective. You want to find a signal that is the most informative for investment under trading frictions. And again, so we have a section in the paper where we argue if you do asset pricing, you extract signals that are relevant for portfolio formation instead of signals that are informative for prediction. And the two don't need to be the same. But if your goal is investment, then you should actually include another penalty essentially in your model that downweights in some form stocks or weights that are related to trading frictions. And we show in the paper there's a trade-off. So we actually show how to take this into account. So it's a bigger picture agenda. If you want to do AI investment, you should extract signals that are informative for portfolio formation under trading friction.
Perfect. Thank you so much, Markus, for the great presentation.